Hey everybody, welcome back to Trades and Gains. I'm your host, Max Pitts, and today was CPI day, and it did not disappoint, but it left investors disappointed. It came in hotter than expected with a 0.5% against 0.3% expected, and year over year it ticked up to 3% from 2.9 to 2.8% prior. Now, again, this was not expected on our end. And the markets reacted negatively to this news, with the Dow Jones Industrial dropping 0.5%, the S&P 500 dropping about 0.3%, and the Nasdaq Composite finished slightly above their flat line. Again, we just went over the numbers of what our core CPI was, and we had earnings reports that came out today as well, with Kraft Heinz disappointed the market with 2025 profit outlook that fell short of expectations, and CVS exceeded earnings expectations and saw a rise by almost 14%. These figures are indicating sectors remain relatively strong, even as some inflationary pressures are starting to take shape within the market. Now we add Reddit and Robinhood in the news as well, and Reddit stock tumbled about 12% after hours following its fourth quarter earnings report. Revenue exceeded Wall Street's expectations, but EPS fell short, and its daily active users were also anticipated lower than expected. And unfortunately, a social media platform, daily active users is a very important benchmark. But on the flip side, Robinhood saw a 6% rise in after-hours trading following strong quarterly results, posting an adjusted EPS of $1.01, higher than the 43 cents expected, and this signals strength in Robinhood's business model despite a volatile market environment currently. And then we have the rising rates in sector performance. So the 10-year hit 4.64%. You remember 4.5% is kind of the oh shit zone for stocks, and it's impacting interest rate sensitive sectors, real estate and small cap stocks to be specific. These areas experienced declines, with the Russell 2000 dropping 0.7% and the S&P 500, as mentioned before, dropping 0.4%. Now, Piper Sandler's Michael Kranowitz described the current market as bifurcated, with stocks in rate-sensitive industries performing poorly while others continue to hold up. This is basically just saying higher rate is the most pronounced in leadership stocks, and the breadth of the market is suffering as a result of these higher rates still being intact. We had AI stocks leading the charge. We called out Intel, by the way. Thanks. Shout out to IC Trades. And it extended its 6% rally that it started this week, driven by comments from JD Vance about the importance of domestic semiconductor production for AI. And again, if these tariffs do take place, a lot of Chinese-based manufactured chips will take the hit. So Intel will finally have a leg up in some way. It may not be the best performing, but it's domesticated and you won't have to pay tariffs on it. And Big Bear AI also saw significant gains today. The rally in AI stocks is a reflection of the growing optimism in the sector, especially in the wake of rising demand for AI-driven technology. And with smart cities starting to come out, why do you think Broadcom is running the way it is right now? Now, housing and used car prices, again, we already went through persistent pressures from the inflation report, so we're not going to cover that again, unfortunately. Now, Fed rate path. Hikes remain unlikely for now. Again, despite this hot inflation print, economists are still not predicting interest rate hikes in the near term. Bank of America's Aditya Bhav noted that hikes remain unlikely unless inflation reaches 3% core PCE, or long-term inflation expects to become unanchored. The core PCE index, which, let's be honest, it's going to be released in late February, will be closely watched for clues in the Fed's next move. However, the inflation data has raised possibilities of rate hikes later in 2025, with Deutsche Bank's Matthew Lazzetti suggesting that the Fed may need to hike rates if inflation pressure persists. Now, on our options market side of things, we had a SPY put buying frenzy. It was put city, bitch. Put city, bitch. Everybody shorting the market trying to get rich. Anyways, the SPY 417, 573 puts. We had multiple sweeps totaling at $3 million in premiums. And for the SPY March 21st, 573 puts, we had 2 block trades worth 1.9 million each, equaling 3.8 million in total. Someone is loading up protection or hedging a heavy position potentially. And in IWM, we saw some high buying pressure for the 213 puts that expire on March 21st as well, with 1.29 million in premiums. Is someone expecting tech to rebound? Someone's betting against the small caps, but QQQ 321, 521 calls, we had 1.29 million in premiums there, and that looks like someone's expecting tech to make a rebound here like Shaquille O'Neal. This tells us that institutions are hedging hard against more downside, but some traders are still betting that tech would shake off the inflation fears. Now, how do you play this? Iron Condor is on SPY right now, so you could sell $580 calls to 590 calls, and you could sell 570Ps to 560Ps. Our target is IV crush and range bound action post CPI. Now, our QQQ Iron Condor is sell 510 calls to 530 calls and sell 500 puts and 480 puts. And volatility cools after initial knee-jerk reaction. For more aggressive traders, scaling into put spreads in SPY and on SPY and IWM could be an option if we see follow through on sentiment tomorrow. So that's all we have in today's market recap. I hope you guys enjoyed this. We're going to start including IC trades and just some of the big options plays that were coming through for the day. But if you enjoyed this, make sure you smash that like button, go ahead and subscribe, and turn on your bell notifications so you never miss another Trades and Gains market recap, because this is episode number 105, baby. Have a great night, and I will see you all in the next one.